You still can't hear me? Yes, we can now. There we go. We have liftoff. Okay, thank you very much for joining me. Sorry about the delay there. I had a few audio issues, but now we are up and running. Let's crack on quickly. Lots to get through. Week ahead. This is for the week starting December the 9th. So as always, just going to ask you to quickly have a quick read through the risk warning. I'll pop myself on mute whilst you do this. Okay, excellent. So that's done. So let's just start by taking a quick look, at what's been happening today. This week. This is the NASDAQ chart that I've got up. I think the big thing to notice about this week is that US stocks are trading at all-time highs. We've also got the DAX in Germany trading at all-time high. We've seen very much a risk-on move across the week. Meanwhile, the US dollar has held steady, virtually unchanged. What we've seen here is data from the US. Obviously, as always, we are doing this just before the release of the US non-farm payroll, but data that we've had across this week, including US ISM services, PMI, manufacturing PMI, jobless claims, ADP payrolls, have all pointed to the same thing, that the US economy is in this Goldilocks scenario whereby it's experiencing growth, but not growth that's so strong that it's causing problems or concerns to the Federal Reserve about inflation. We heard from Federal Reserve Chair Jerome Powell this week, who is still didn't deter from expectations of a December rate cut. However, he did sort of signal towards a slower pace of rate cuts across 2025, which is something that other Fed policy speakers have also been alluding to. Now, stocks are, as I said, trading. We've got the NASDAQ, the S&P 500 and the Dow Jones hit all-time highs this week. As the market cheered the ongoing sort of, Goldilocks scenario, upbeat data, and just broad optimism. Seasonality comes in favor in December, although we do often see a slightly weaker start to December before strength can occur towards the end of December. Just because it's happened in previous Decembers does not mean that it's necessarily going to happen again this year, but that's what the Santa Rally is all about. So let's just then crack on with what we've got going on next week. This is the there it is, economic calendar. I have filtered it for the high impacting events, and I think the most important one that we're going to come across next week is going to be US inflation data. That's going to be on Wednesday. Now, as far as expectations are concerned, the US inflation is expected to tick higher to 2.7%, up from 2.6% in October. And on a monthly basis, we're expecting it to see it rise 0.2%, in line with what it has done for the past 4 months. Core inflation is expected to hold steady at 0.3% and 3.3% on an annual basis. Now, just having a look at what the swaps market is saying, inflation is expected to come in slightly hotter than expected it's likely to come in slightly hotter. They're pricing in a 0.27% increase month on month. Now, if this proves correct, and we do actually see a hotter than expected inflation report, then this could see the market come under a little bit of pressure, especially if we see a strong jobs report today. Now, obviously, as I said, we don't know what the non-farm payroll has come in at although it is expected to be at 200,000. So if we see a solid jobs report and an uptick and an unexpected uptick in inflation, then that may be enough to put the brakes on the rally in the NASDAQ and the S&P that we've been seeing in recent weeks. Just as far as technically speaking, we can see here, this is the NASDAQ that we're looking at, and it's really played catch up, but it is trading in a rising wedge, which tends to be a bearish reversal pattern. We are just below that 21,500 level, pretty much trading at all-time highs. RSI isn't overbought, so there is a potential for a little bit of a further move higher. If we get above the 21,500, then even up to 21,600, which is the upper band of that rising channel, there is potential still there. Just as far as the downside is concerned, 21,200, that's going to negate that near-term move upwards, and I think it's going to take a move below 20,300, which is the mid-November low, to create a lower low. So we are still some distance off seeing a change or a reversal here. So that's where we are with the NASDAQ. Just having a look at the S&P 500. Again, not too dissimilar, the picture here, trading around all-time highs. We've seen this run higher, trading again within a rising wedge. If we do get that sort of stronger than expected inflation data, then we might see that just come off from those all-time highs. Immediate support there at 6,000, round number. It's also the high that we saw earlier in November. Again, here it would take a move below 58.30 to create a lower low. So we're still, you know, we're quite some way from that. So, you know, any move lower could be considered a buy the dip unless we move beyond the 58.33 level. Now, it's just interesting to obviously see what all this means in relation with the US dollar. This is the US dollar here. It's trading, it's sort of rallied to that all-time high, sorry, that 2-year high that we saw at the end of November, but it's actually come off since then. It's trading below the 106.20 level, but it's trading still above this trend line here, which, I mean, maybe we see that better in a weekly chart, which goes back to September 2023. So we're still holding above that level. So we're still overall, you know, this dollar strength story that we've seen still pretty much remains intact, although it has come off the levels that we were seeing previously. So I guess, what does all this mean for a major such as GBP USD? This is, let's just get rid of that one. This is sterling US dollar. So we're seeing that as we've seen that US dollar come off, we've seen that the pound is actually managing to capitalize on that slight weakness. And it's recovered from that low that we saw of just below 125. So we've seen a pretty solid recovery above the 126 level, which was the June low, above 127, and now we're trading out above this falling trend line, falling channel, which we've been in since over the past 2 months. So things are starting to look quite a bit brighter for sterling. I think we really need to get above the 200 SMA, which is at 128.25, in order for buyers to gain momentum and feel more confidence ahead of the 128.50 level. There isn't much in the way of UK data next week, so that does mean that the USD is likely to be in the driving seat. It's worth just noting, though, that the Bank of England is not expected to cut interest rates as aggressively as previously expected, and that's after the Labour budget that was unveiled at the end of August, which is expected to be inflationary. And so that has meant that the sort of rate cut expectations for the Bank of England have been reined in, which has seen a slight strength, or offering support at least, to the pound. So I think the other one, whilst we're talking about inflation and the US dollar, let's take a look at what this is for gold. Now, again, gold has come away from its all-time high of 27.90. I think broadly speaking, this upward trend, the longer term upward trend, just about it remains intact. We can see it's still just about above or testing that rising trend line, but we haven't seen a lower low formation yet. That would need to take place below 25.50. We are actually just consolidating here around this sort of 26.40 level, but if we just have a look at that sort of engulfing bearish engulfing candle there, that's quite an ominous sign. Even though we've got that sort of longer term uptrend, I think for now we're definitely in a consolidation phase. There is a potential to see a move lower. We would need to take out the 2600 level in order to bring 25.50 into focus. Now, if we get a break below 25.50, we're creating a lower low, and that's starting to change the structure of the chart. On the upside, look for a breakout above the 50 SMA, which is 26.70, and this level here, which is 26.80. That was the high that we saw in September. Above here brings 27.20 into play, which will then create a higher high. So that's gold. RSI pretty neutral. Now, next week, if we just take a quick look here, is a big week for central bank interest rate decisions. We have ECB, we've got RBA, we've got Bank of Canada, we've got Swiss National Bank. We have a lot of central banks reporting next week, and obviously don't forget they're reporting their interest rate decisions come ahead of the Federal Reserve and the Bank of England in the following week. So let's just pull up Euro US dollar, focus on the ECB interest rate decision. Okay, Euro US dollar. So ECB is expected to cut interest rates by 25 basis points on Thursday. The market is pricing in around a 93% probability of such a scenario. And the central bank could bring with it some dovish rhetoric, which would further fuel expectations of rate cuts in the following meetings. Now, if we think about that in comparison to where the Federal Reserve is, there is obviously a divergence in monetary policy outlook. Just where the sort of macro picture is in the Eurozone, we did see that inflation ticked up slightly above the ECB's 2% target. However, we've also seen sort of, a weakening in the economic data, so in the sense that the PMI data showed that business activity, the composite PMI, was down at a 10-month low. We also saw retail sales fall. We've seen that also the picture in Germany is particularly weak. The manufacturing contraction in Germany continues as it does in France. Now, add all that weakening economic outlook into the fact that we've also got this rather unstable, uncertain political picture in both France and Germany. Now, this week in France, we saw that Prime Minister Michel Barnier faced a vote of no confidence, which he lost, and as he tried to push through a budget without Parliament's approval. Now, it's quite interesting the impact as the Michel Barnier faced that vote of no confidence, which resulted in the collapse of the French government. We actually saw the euro rise. We've also seen the CAC rally this week, up 1.7% after several weeks of losses. We've seen the DAX, I'll show you shortly, reach an all-time high. So it does appear that the market is actually made peace with what's happening. It's been priced in. We've seen what it's expected, and it's been priced in. And now the market is just really waiting for fresh developments, which could come as soon as this weekend. Macron has said that he will look for a new prime minister. So yeah, the market's a little bit in wait and see mode as far as France's political situation is concerned. Then we've also got Germany's political situation, which again is rumbling on, the uncertainty there with an election due in February. So obviously, I mean, the ECB doesn't take decisions on political outlook, but if you do have levels of instability, that's not conducive to strong economic growth. So I think just as far as what we're expecting here, I mean, 25 basis points is priced in. So that might, that's not likely to create any big swings in the euro or the US dollar. I think what could is if we have more dovish rhetoric from the ECB, that could pull the euro under pressure, especially if we see stronger than expected US inflation data. Levels to be watching out for on the downside. Obviously, you've got the 105 level, which is here, and then the low from 2023, which is 104.60, 104.50. If we get a break below that, that brings 104 and 103.30 into play. If we do have a less dovish sounding ECB, if they're sort of focusing on that slightly hotter than expected inflation print, then we could see a rise above. And if we get sort of cooler than expected US inflation data, then we could see a rise above that 106 level. That 106 level is pretty key in order to be able to neutralize this sell-off and move up towards the 107 level. Whilst we're talking about the ECB, let's just have a look at what all this means for the DAX. As I said, all-time highs. DAX is being supported. I mean, despite the fact that you've got a slightly political uncertainty, despite the fact we've got expectations of trade tariffs from Trump when he comes in, we're still finding the stocks here are trading at all-time highs, and that's basically because they're boosted by expectations that the ECB will continue cutting interest rates and will continue cutting interest rates probably for the foreseeable future, which is why we've got this very strong rise up there. It's also tracking all-time highs in the US, particularly the tech stocks. However, just be wary here. We are in overbought territory, so buyers should be cautious. There is an increased likelihood of a pullback or a sell-off from these levels, whilst the price stays above this level here, 19,670. That was the high from October. Then the uptrend remains very much in play and could look towards the 20,500. If we get a break below here, it does just neutralize that recent run up, and it also brings into focus this level here, which is the 18,850, which was the low that we saw in November. A break below there will create a lower low. Excellent. So next, what do we have? We have AUD. Got the RBA interest rate decision. Okay, RBA, they are, let's see if I can just spell that properly. RBA are not expected to cut interest rates. Okay, so we're not expecting a rate cut from the RBA until potentially April next year. That's basically because of the resilient labour market, which is keeping inflation elevated. So we're expecting them to keep the rate on hold at 4.35%. They're basically the only major central bank that's not started lowering interest rates, and this is basically because it increased interest rates by less comparatively. It's only lifted by a modest 425 basis points between May 2022 and November 2023. Now, just think about inflation. It has actually cooled back to 2.8%, which is within the RBA's 2.2 to 3% target. We are seeing that core inflation remains stubbornly high at 3.5%, and unemployment is still around record lows, meaning that the RBA is likely to keep interest rates higher for longer. Rate cut 25 basis points is priced in at a 70% probability in April. So the market's going to be looking to see how dovish or hawkish the RBA is sounding in order to be able to assess the likelihood of, you know, a rate cut in first quarter of next year, or whether it'll be into the second quarter. Despite the RBA being quite a bit more hawkish than the other central banks, and despite the fact that we've got US stocks trading at all-time highs, so there is an element of risk on, actually the Aussie dollar isn't performing so well, and this is actually, I think, more a reflection of China that's being played out here, and concerns over that outlook as far as China is concerned. Now, as I mentioned, we do have data. We've got inflation from China, which is due out on Monday, so that could also have an impact on the Aussie US dollar. Trading above this rising trend line, which dates back to 2022, October 2022. So if we can see there, we did just test it, really, almost, not quite. But so, you know, that's some way down yet. Hang on, let's just take a deeper look. I mean, you know, if we have a look, this is the price has come down quite sharply over the past 2 months, as we've seen with a lot of the dollar crosses, but this one hasn't really done the same recovery that we've seen in the euro and sterling. Instead, it's sort of been creating a series of lower lows and lower highs. That level that we're looking for is around the 63.80. That's the rising trend line, support that goes back to 2022. RSI is suggesting that we could see some further declines in this pair, but yeah, so that's the level, and below that then we've got also here the 63.50, which was the low that we saw for 2024. Any recovery is going to want to sort of retake the 65 level, and then above that we've got the 65.50, which was last week's high. We've got the 50 SMA crossing over the 200 SMA and a golden cross, bullish, a bearish trend, bearish signal there as well. So that's just something to be wary of. 200 SMAs at 66.25. We touched briefly on China, so let's just have a quick look at what's going on with the markets. So obviously we've got inflation data out of China, as I mentioned at the start of the week. Interestingly, we've seen that the equity market in China is, I mean, it's holding above that sort of 13,000 level that we've talked about for some time now. But equally, the recovery isn't exactly looking full of beans. The next level to be watching out for is the 13,500, which is what it's sort of attempting to move above, but we're sort of being guided higher under the 50 SMA. Really, we would like a move above that level in order to feel a bit more bullish about a look towards 14,000 and 14,300. So that's what's going on there. If we get the inflation data coming in weaker than expected, that could hit sentiment and pull things lower in the equity markets. Then finally, we've got the Bank of Canada, who is also set to release their interest rate decisions. Now, Bank of Canada, they've had 4 straight rate cuts over the past 2 months, and another interest rate cut is expected on the December the 11th. Now, the market is undecided whether that's going to be a 50 basis point cut or a 25 basis point cut. But there is a possibility after several 50 basis point cuts that it leans towards a slightly slower pace of reduction. And that would take the rate to 3.5%. The meeting comes basically after GDP figures help to reinforce that interest rates are too high and they need to be lower to help growth. We've also got the unemployment data, which is due shortly from Canada, which could help make some provide some clues as well. Just as far as this USD CAD is doing, we've seen it's been trading a series of higher highs and higher lows. We sort of stalled around that 141 level. I mean, obviously we spiked up to that 141.75, but I mean, we haven't really been able to push past that 141. Price is just consolidating, really. It's coming down as far as levels to be watching. 139.50, that was one on the downside. If we get below there, then that could create a more downbeat outlook for the pair to 138.30. On the upside, a rise above 141 brings 141, the all-time high of 141.60 into focus. Sorry, 141.70 into focus. Right, lastly, but very much not least, let's just do a quick look at oil to see what's going on there. But we are, as always, trading within that familiar range that we've been talking about for so long. Just levels to be watching on the downside, because we are getting a little bit closer to that. Is 67 sort of 50, 67.25 on the downside. A break below that opens the doors to the low that we saw here of 65.25. So yeah, so just watch out for that downside breakout. If that does happen, then we could see a deeper sell-off in the price of oil. So thank you so much for your time. I hope you've enjoyed it. Just to mention that this will be the last one now until January. So we'll be back in January with our weekly week ahead reports. Thank you very much for your time. And happy Christmas. I'll speak to you the other side.